There's no like novel technology risk that we're taking, that we have to go solve something that might violate the laws of physics. The thing about our model and how I capitalized Cabana is that we raised almost entirely from VCs. Mm-hmm. So it is a venture bet, but unlike most venture bets, where you are yeeting your dollars into a cash incinerator, some early stage startup, and hoping it gets to escape velocity before going to zero, and hoping and praying that it doesn't dilute you to smithereens in the process. Here, we're buying cash flowing assets, and we're recycling those cash flows to buy more cash flowing assets.
Thank you for joining me. You're building an exciting company, originally called Splash, now Cabana Pools, right?
That's right.
And before that you built Lawn Love, and before that you built another home service business.
Yep.
What is it that draws you back to home service businesses?
I kind of fell into home services and didn't set out to be the home services guy, but now I've spent 15 some years building at the intersection of home services and tech. Yeah. I originally started in 2009. I went to go book a housekeeper and realized that the entire kind of maid landscape was super fragmented, largely offline. The vast majority of players were, you were either going to Craigslist or Yelp, and quality was all over the map, or you were going to one of these big franchise players like Molly Maids, Merry Maids, and even they weren't using much in the way of software to run their business. So, I previously started an agency where we built kind of consumer products and did a lot of growth marketing work, and realized that there was an opportunity to just go apply these skills to this like largely low tech, very legacy, largely offline category. I mean, house cleaning is tough, man, right? Yeah. Like you're breaking the threshold of the door. Yeah. You need narrow arrival windows, right? You got to show up and meet the customer on site. The trust barriers are huge. You're actually letting someone in your home. Theft, loss, there's all real risks that you don't have out of home. Yeah. So I ended up starting essentially a bootstrapped handy in my early 20s, grew it for about 3 years, sold it to a PE fund in my mid-20s, took a week off, and then started Lawn Love, which is the company that I spent about 8 years growing into a national brand in lawns.
Okay. And Lawn Love was similar, right? It was like the handy but for lawns.
Yeah, very similar. So what I would call a managed marketplace, book a gardener on an app sort of affair. So we built a full suite of kind of back office field service software on the back end. We probably wrote too much code, should have bought a little more and built a little less, but we built billing tools, customer support systems, analytics, routing optimization algorithms, everything. Yeah. And then used that to build essentially a Uber style model for lawn care, and grew to about 120 cities, 40 states, had about 7,000 guys on platform mowing lawns every day, about 250 some back office folks running the company.
Oh, that's a lot of people. I also had a similar realization in my first company. We built way too much stuff. I had this great CTO, smart guy, loves to engineer things. I didn't know what I was talking about. I'm not a product manager. So if he wanted to build something from scratch, because the off-the-shelf solution wasn't as good, we would build it, right? But then eventually you realize that if you build it, you have to maintain it. And actually, we should have picked, the Salesforce infrastructure and done our little tweaks. Even though it wasn't perfect, we don't have to maintain it. There's somebody in San Francisco that's maintaining it for us.
Yeah, that's the thing I think everyone fails to fully burden that calculus, right? It's you can go build bespoke novel solutions to your special idiosyncratic needs as a company, and it's great, gives you leverage at first. And then you have this massive bloated code base to go figure out, and then your CTO moves on 4 years later and takes all their tribal knowledge with them, and you're messing with DevOps and reliability and uptime and all sorts of chaos. And we are very much it is a software first approach that we're taking to pools. I like to characterize ourselves as technologists masquerading as finance guys, masquerading as pool guys. Yeah. Right? I have a ton of blue collar guy now. I have a ton of blue collar DNA. I've been in this, home services blue collar space for 15 some years. Yeah. I know it, I love it well. But have a lot of background in other categories that we can bring these kind of skills to bear to both grow faster and build better models, drive margins up, run the business more efficiently. And to do that, we have to build custom software, and we will be doing this, but we're going to be smart about, not reinventing too many wheels and building what we need and not what we don't.
My understanding is that Cabana, you are buying businesses, right?
That's right.
But at Lawn Love, you didn't buy the businesses?
That's correct, yeah.
Okay. How did you grow, or how did you hire people, and did you have to train them, or how did that all work?
Yeah, so Lawn Love was a 1099 marketplace model. And one of the bigger challenges with the 1099 kind of I guess, human labor marketplaces broadly are that you, in some ways, you have an adverse selection problem on the supply side of the business, where if you are a really good lawn guy, you probably already have a packed calendar, right? Like you have more customers than you know what to do with. You don't need me.
Yeah.
So if you're coming to a Lawn Love and you're giving us 20, 30 cents of every dollar, you're either a brand new lawn dude who's just minted into the industry and you're great, and we got lots of those on the platform. Those are our kind of peak performers. Or you might be a lawn provider who has retention issues, right? You have issues retaining your customers, and there might be a reason for that.
Yeah.
So the whole game ended up being, how can we build software and tooling to try to like create great, consistent customer experiences out of a supply base that was sometimes quite variable, sometimes amazing, sometimes not so much, and you can't train them because it's a 1099 model, so your hands are basically tied behind your back. It's a labor law violation to train your workforce. They're not your employees, right? And so it's this, it was a challenging model, no sort of M&A driven growth on that one. We just got really good at SEO and SEM.
Okay.
So I built LawnLove.com into a top 3 property in lawn care on Google. We beat out Thumbtack, Yelp, Home Advisor, Angie's List, all these guys. We generated about 1 million uniques a month and 300,000 some odd leads a year. And that's a big part of the playbook that we're bringing behind Cabana is we're going to go buy amazing legacy pool cleaning companies. We're going to partner with them and help kind of improve them operationally through all the usual means. But then we're really going to help grow them organically because that's what, I have a 20-year growth marketing background. That's my DNA. And pipe all that organic growth into the companies we acquire. And then once we have a decent footprint in a geo, start to build the actual kind of bespoke field service software that allows us to scale and operate them more efficiently, creates more competitive moats, really helps us run the business in a differentiated way. So that's the playbook.
What did you learn at Lawn Care about managing talent using technology? Like, how do you take a group of tens of thousands of 1099 contractors with varying degrees of work effort, let's call it, like forget skill, right? Like some people, I'm sure, were showing up late, right? Some people were not communicating with their customers. Some people cut the little hedge that the customer loves by accident.
Right.
What did you learn about using technology, and where did you see the greatest improvements?
So one of the first things that I learned, having played in like in-home with maids and carpets and windows, and then out of home with lawns and now pools, is that like these different home service verticals look very similar on their face, right? You're calling someone, you're getting a quote, you're booking a job, you're scheduling a service tech, you're dispatching the tech, they go render service, you charge the customer, done deal. And like that workflow is largely similar across these different verticals, but the devil is in the details, and each of these different categories has loads of nuance around how sensitive customers are to, service quality. House cleaning, for example, was wildly variable. Like different people have very different definitions of what constitutes a clean home,
right?
And it was like almost impossible to underwrite this, right? Or like you could train a house cleaner to be amazing, and they would be too slow for one guy and perfect for the next customer, right? Or someone's really fast and super efficient, and their customers love them, but they are insufficiently detailed for the next customer, right? And so like you almost need these psychographic maps of your customers and like matching it to the actual like performance kind of norms of your supply base. But that's not nearly as big of an issue in lawns. Lawns are out of home. People do care about the grass, but it's a little more binary, right? Like your lawn's mowed sufficiently well, your plants are trimmed. Yeah. Hopefully you don't mow over sprinkler heads and cut people's favorite like peony patch. But it's each of these different verticals has shades of nuance and I think quality barriers that are different. Pools are also fairly binary, right? Like your pool is either clear or not clear. Right. And while water chemistry is devilishly complicated, it ultimately translates to, is my pool pretty and swimmable? Yeah. Is it clean? And if you are achieving that, you can do all the magic behind the scenes. You're not having to I love that you're not having to skate to some like nondescript variable, like miasmic definition of success. Like what success looks like, and you just have to go achieve that success. Difficult as that may be. But yeah, so how to use technology, we would look at everything from like retention rates on the supply, under the theory that if you are a pro on the platform and you have a really hard time retaining customers, especially first time accounts where we give you a new customer and that customer churns subsequently, you're either probably disintermediating us and poaching to take customers off platform, or you're just doing a sufficiently bad job that customers choose not to recur. And that's a huge red flag. So we built a bunch of like binomial analysis and kind of like regression statistic stuff in order to figure out where provider performance was falling outside the median provider, and we'd either drop them or coach them to get better if we saw that pattern.
So when you started Cabana Pools, I saw your announcement, I think it was on LinkedIn and Twitter, and it went super viral. You had hundreds of comments, you had hundreds of likes, people were sharing it, so you have a lot of fans out there, which is cool to see. People rooting for you. It feels like you could have, given your experience, it feels like you could have pursued any field where you were buying businesses and implementing new systems. I imagine you probably spent some time researching pools. So why did you end up in pools?
Yeah, so I guess tell you the mid-length version of the story. Yeah. But so I ran Lawn Love for about 8 years, and after scaling it to a national brand in lawns, ended up selling it in 2021. We partnered with a company called Lawn Starter, great dudes, to create the largest marketplace in lawn and garden in the country. I was stuck around for a year, kind of handcuffed to the business to help the transition and make sure the integration went well, and then found myself newly free after a nearly decade-long conquest, and trying to answer the big existential questions of what was worthy of the next decade of my life. And I tried a lot of things. Like, I didn't immediately come back to home services. I looked at, I mostly just tried to not put too much pressure on myself to find the next thing too quickly. I got some good advice from other founder friends who'd had exits that you should set an anti-deadline and not torture. Like, essentially a deadline before which you don't torture yourself if you haven't yet figured out what's next.
Yeah.
Because like I think we're all like very kind of go-getter types, right? Like, it's in our nature to want to immediately find and seize onto the next thing and start running at it.
So you're saying, like, let's say today's January 1st, I'm not going to start anything or commit to anything before June 5th.
Exactly.
Okay.
Yeah, and I'm not going to like give myself shit for it if I do not do this.
Yeah.
Right.
That's probably the bigger one.
Yeah, because otherwise you're just like internally torturing yourself, right? So that worked. I traveled a bunch. I spent time with my son Jack. Got married. Bought some real estate. Played around. Did various things. Played some video games. But really, when I got back to it, I mostly tried to very deliberately avoid viewing every new opportunity through this lens of whether or not it was liable to be $1 billion plus company. And that, I think, is a very common failure mode that successful founders fall into, is that I think it's human nature. You tend to want your next chapter to be grander and more momentous than the last. And after a certain point, there's only a finite number of obvious $1 billion ideas, and most obvious $1 billion ideas are kind of bad ideas, right? They're like overfished ponds, or they're tar pits for some reason, and they're actually not good ideas. And really the way to find great ideas is either to like mine something that you know intimately and that comes naturally to you, where you have some unique differentiated insight into, and honestly to just play around a little bit and not predicate every single project through this lens of is this a $1 billion idea? It's airbeds and breakfasts, right? It's a black taxi service for rich people in San Francisco.
Yeah, Uber.
Yeah, it eventually evolves into this thing, but that was not the genesis of any of these ideas, right? They started in a much smaller, almost like kind of forgettably small form, and then have evolved into the much the behemoths that we appreciate today. So I tried to play around a bunch. I started a Gen AI company with a buddy out of Airbnb that used LLMs to read, summarize, and annotate the news, hoping to get kind of people to read across their filter bubbles and read across trouble lines a little bit. Awesome product, actually works, should exist, good for the universe. Also means that you're directly competing against Facebook, Instagram, and the New York Times for finite attention spans, which is a terrible idea.
Yeah.
So played around in that, built a marketplace quickly to kind of help people find builders for ADUs, helping address kind of housing crisis issues in California. There's a massive amount of supply constraint in California.
Like a for ADUs?
For general contractors, right? It's actually, I think it's still a good idea. Like California has woefully expensive real estate.
Yeah.
And this is mostly a policy problem because we don't build enough. And one of the ways that we can alleviate this supply constraint is by building in people's backyards and converting their garages and backyard space into livable housing. And SB 9, a kind of assembly bill passed some years ago, which allows you to subdivide lots and convert them into ADUs. The challenge is that there's a kind of a scarcity of financing for ADU construction, and it's really hard to find good ADU builders to go out and actually build these units. And so a lot of people would happily build an ADU in the backyard and create new housing, which would have profound effects on kind of supply shortage. But it's just hard to do the actual work. Permitting's a pain in the butt. It's hard to actually like design housing plans. I don't know if you built a custom home. It's painful. Like it's a lot of work.
Yeah.
And like you're dealing with all the short-lettered regulatory bodies that make life hard.
Yeah.
Anytime you have to contact them. So a marketplace that streamlines it, alleviates it. Interesting idea. So I played around with that. I ultimately, through all of this kind of, I guess, exploration, realized a few things about myself. I guess some foundational truths. The first of which is, I'm not a 0 to 1 guy. Like some people are built for the 0 to 1. They thrive in this world where they're, navigating the idea maze and they're, have solutions in search of problems, and it's like the constant sprints toward product market fit. I don't like that because I like running really fast. And when you're in this 0 to 1 space, it's hard to move quick enough because it's always one step forward, figure out if there's a there, one step back. You don't really want to sprint too fast at any one thing because you might be on the wrong path. So it's this like statico, stutter stepping of exploration, and it just feels slow to me. It doesn't feel like it's like I can't get my hands around a tangible problem and go eat it faster than anyone else.
Yeah.
And that's most of what my career has been, is like playing in competitive markets where I'm going to live or die based on the vicissitudes of Google Ads and marketing spaces and SEO rankings. And so I'm happy to go like make my bones competing against people toe to toe in hard spaces. I don't like running at nondescript opportunities that may or may not actually be anything. And so as I realized that, I also realized I was a like fairly undifferentiated player in AI. Right, like it's this huge wave. It's obviously ascendant and transformative and important. It also has like 8 billion people trying to run after like prizes in that category. And like I'm like a B-grade AI founder. There's nothing special about me there, but I'm like a relatively differentiated home services founder, right? Like I have a kind of unique intersection of deep technology and growth marketing experience and deep blue-collar home services experience. So I finally, after all this like exploring, came full circle back to, you got to build another home services company, right? Like you spent 15 years building in this space. I guess it's time to spend another 15, right? And the good news is you don't do anything for 15 years if you don't kind of love it. So I really do love building in this space. I love working with the people. I like solving these sorts of problems that are, tractable, tangible. You see the effects in kind of atoms moving through physical space. It's amazing. And so I then just explored a ton of different home services categories. I looked at HVAC, plumbing, garage door, foundation repair, you name it. Ultimately landed on pools. The reason I picked pools is that it's actually kind of synonymous to lawns. Pools and lawns are both small ticket. They're out of home. They're density driven. They're predominantly residential, but there's a meaningful commercial element. Similar labor dynamics and similar dispatching kind of flows, similar customer acquisition flows. It really is the most analogous thing to lawn care as pools are. So landed on pools, started Splash, which is now Cabana, and have never looked back.
Okay, that makes sense. So you've bought your first 2 businesses.
3 now, and we have done about 6 bolt-on acquisitions as well.
Okay, you guys are moving.
Yeah.
When did you start?
9 months ago.
Okay, you're really moving.
Yeah.
And so within Cabana, this was your first time acquiring businesses, where like you've never acquired a business before, right?
I have been on the sell side of many transactions. I sold a few, and I got close to acquiring companies that we walked away from at Lawn Love. We were close to 2 deals that we ultimately declined to do, but first consummated closed deal, Cabana, deal 1.
Okay, what was deal 1?
So deal 1 was this firm called Pool Logic. It's actually this gentleman named Kyle Bowman. And I had met him a couple years earlier when I was exploring what to do. I was looking at different kind of home service categories. I hadn't decided on what vertical I was going to be playing in, and called a bunch of pool guys just out of the blue, along with HVAC and duct cleaning and countless other categories. But I just scraped a bunch of targets, called them all, asked to get lunch with them, introduced myself. Ended up getting lunch with Kyle, and at the time his business was quite a bit too small to buy as the first kind of platform acquisition, but I loved how well it was run. Kyle's a smart founder. He cared a lot about doing things right, And you'll notice in any business, but often in the trades, there's a lot of ways that you can cut corners, right? There's a lot of ways to drive incremental margin performance by shaving off compliance and doing things like not quite correctly.
Sure.
Kyle did things well and really had his, I think, eye on the right targets, which were customer experience and the team. And, but it was way too small. I think it was about 250 pools at the time. And so we kept in touch. I told him, like, hey, in a world where you were to find another company and buy them, I would love to talk. And he actually proceeded to go do exactly that. So he, to his credit, found a deal, negotiated it, closed it, kept me kind of apprised along the way. At this point, I'd started to develop a really robust notion around pools and built out a really kind of articulated thesis, and knew I was going to build a pool empire, and that was unambiguously the mission. So then it was like Kyle became more and more important, and this company was obviously like a great first opportunity. And he ended up closing on this other deal in December of last year, and then we bought him 3 months later in April.
Okay.
Yeah.
So walk us through the structure of a deal like that. What's it look like? How do these work?
So, without giving exact details, because slightly privileged there, it was heavily seller financed. It's about 2/3 or 40% down, 60% seller for that first deal. And that was really important because we'd, at that point, raised some money, but we have finite equity dollars, and you get kind of more bang for your buck and more leverage should you be able to do some seller finance deals.
Sure.
Also, critically, this, but when you're far along in the path, like we're already at a place right now where we can go get senior debt 9 months later, because EBITDA is good enough that the banks will underwrite you. But when it's deal one, you don't have any EBITDA to underwrite, right? Like, your best bet is you're going to go get mezz debt at like 19% from some predatory, granted, love them, lender.
Yeah, they're doing their service.
They're doing their jobs,
Yeah.
and it's a reasonable thing, and I think they're pricing it appropriately to the risk. Nothing against them, but it is enormously expensive.
Yeah.
And so, like, I think to us, being able to do the first deal with a meaningful seller component was helpful because it allowed us to queue up more deals and get real traction. And the whole question was, we raised a $6.7 million seed round. How much momentum can we get on that finite slug of equity? And that is more or less going to tell the tale for the next round that we queue up, which we expect to raise in 6 or so months. So that was the first deal. Kyle also ended up sticking around, and I know you know this, and I'm sure you've talked about this with other founders, but it's hard to stress how important deal one is, right? Like, when you have multiple shots on goal and it's like, an N of 20 or whatever, and it's your incremental 21st deal, it can go wrong, and it doesn't really matter. Like, it's bad, but it's, 20 month worth of bad. Whereas if it's your first deal, it can put you in a massive hole that you're gonna have to dig out for a long time.
Yeah.
It, like, peas in your pool,
Yeah.
so to speak. Right? Like, it's hard to tell the story when your very first deal was like clearly not a good one. And so Kyle sticking around and committing to run the company has been enormously valuable, because as much as I have experience in multiple home service verticals and I've spent a whole lot of time in this space, you'll see, I think, a lot of first-time founders get in and think that they're all largely, similar, across categories. But home service verticals are unique. They each have their own hair. They're novel. They have, nuance and idiosyncratic problems that you got to go solve for. One vertical to the next. So having a deep domain expert who has forgotten more about pools than I knew at the time is amazing, and I'm super grateful for him. He's a great dude.
I want to talk about your investing structure in a moment and how that affects your business. But let's talk a little bit more about how these acquisition structures work. So, how did you retain Kyle? Are you paying him a salary? Does he own equity in the business that rolled over? Does he own equity in Cabana? How do you think about, if you do want to retain the leader of a business, what's a good partnership look like?
Yeah, so I think it's going to be unique to the person and their needs. But in Kyle's case, paid him a salary, And he was also, I think, meaningfully incentivized by the fact that we had a large seller note, so wanted the thing to go well. That's another thing about aligning incentives. One thing I learned after this deal, Kyle amazingly also turned around and reinvested in Cabana as an investor.
Great.
Not as a part of the deal, like separately. Once we'd had a couple months working together, he has to write a check.
Yeah.
So, one, amazing vote of confidence, but also, I think on some level, Kyle is a unique individual and he's just intrinsically motivated and wants to do the right thing. And again, like, I can't say how lucky I consider myself to have partnered with him as kind of, ground zero partnership. But, absent the, specialness of Kyle, one thing that I realized after doing this first deal is if you have a large seller note, it's great in that the seller doesn't care, it cares deeply about it not going badly.
Right.
But beyond it not going to zero, such that they can at least get their money, do they really care about you growing 50% or 100% year over year?
Right.
Are they going to burn the midnight oil to make sure that that happens?
Yeah.
If they're not incentivized for the kind of upside scenario? If their only incentive is just don't let it crash and burn, then they're going to do that, and maybe nothing else. And so I realized with subsequent deals where we were relying heavily on the sellers as go-forward GMs, we would definitely need to make sure that we incentivize them on the upside, not just the downside.
Mm-hmm.
And so that's how we've now started to structure things. In a world where the most recent deals that we just did in January, those are all in markets where we're currently operating. And so it's easier in that world to do deals and not even keep the sellers for very long at all, which is one of the beauties of buying businesses that are largely identical to each other. And we can talk about that too.
Yeah. That's a great insight about aligning the upside performance as well as the downside performance with people that you want to stick around. I usually think about it the other way, right? Like most people in tech, let's say, are aligned on the upside, right? They get some equity, but they're not aligned on the downside. So when things go bad, shareholders lose, but when things go well, the employees get to participate as well. So I oftentimes try to think about how do I balance that dynamic for key people.
I mean, it's a kind of microcosm of our business broadly, which is I like to characterize it as a venture style bet with private equity style downside protection.
Mm-hmm.
It is a venture style bet in that if we think we do what we're going to do and what we can do, it's a multi-billion-dollar outcome. We're building an IPO scale business. We think we can build the first national brand at pools, and yeah, it's going to take some time. Our time horizon is much longer than your average PE fund, but we have line of sight to it. It's mostly an execution question, and we're happy to put that on our backs and go do it. There's no there are no unknowns.
Right.
There's no novel technology risk that we're taking that we have to go solve something that might violate the laws of physics, right? Like we know what to do. It's just the doing.
Right.
So we're gonna go do it. But the thing about our model and how I capitalized Cabana is that we raised almost entirely from VCs. Mm-hmm. So it is a venture bet, but unlike most venture bets, where you are yeeting your dollars into a cash incinerator, some early stage startup, and hoping it gets to escape velocity before going to zero, and hoping and praying that it doesn't dilute you to smithereens in the process. Here, we're buying cash flowing assets, and we're recycling those cash flows to buy more cash flowing assets, and we're using software to improve the margin and cash flow of those assets. And we're growing them organically on top of inorganically. We're firing on 2 vectors instead of 1. And that's just and in the world where we don't hit our very lofty goals, we have a basket of very valuable assets. We are valued, at worst, like a very well-performing private equity firm.
Right.
At best, like a IPO scale venture style company.
Yep.
So it's a venture bet with IPO with kind of PE style downside protection.
You're speaking my language. Yeah, we love it.
Live and dream it.
So taking a look at the performance of some of these businesses, just broad scale or broad strokes. Let's say there's a business that does $4 million of revenue. Mm-hmm. What kind of profits does the owner usually see? What's the range?
So average in pools is 10 to 15% net EBITDA margins, which is fairly low. It's not great. If you run it really well, you can get it to 20. Mm. And what does it mean to run it really well? Well, it means not giving away the store to, random vendors, negotiating your chemical costs well, driving route density, which is huge. One of the reasons I think people haven't built national brands in this category is much like lawn. It's very density driven, right? The beauty of HVAC, and the reason HVAC has been eaten so thoroughly by PE, 2 reasons. One, there are large assets to go buy. So you're a huge PE fund, you're playing the AUM game for fee reasons, and you need to write large checks subsequently. That means you have to go buy large assets in order to deploy these dollars. There are $30 million EBITDA HVAC companies that those companies can go acquire, those firms can acquire. Doesn't exist in pools, right? Like pools are hyper fragmented, super subscale. You got to glue together all these, mom and pop sized assets into a bigger, cohesive, performing whole. That takes technology, that takes deep operating chops, that takes a lot of other things. It's one of the reasons why we like this industry. It's one of the reasons why it has yet to be eaten by private equity, is that there's just nothing of scale to go by.
So on a business doing $4 million of revenue, maybe they're taking home $400,000 to $500,000 on the high end. So let's say $4 to $450.
$4 million in revenue, they'd be taking home anywhere between $400 to $600 is pretty normal.
Okay.
And if you run it well, so again, route density being the name of the game, if you can drive route density, your labor margins immediately improve, right? Your guys are cleaning 16 pools a day instead of 6 pools a day. Mm-hmm. Enormous leverage. You also are driving, I think, a pretty meaningful competitive moat, because your run-of-the-mill, just got started yesterday pool guy will not be able to compete with you in terms of density, because it will take them years to acquire customers and like slowly through meticulous process pare that customer list down to the hyperdense route. If you go buy companies that are 30 years old, they've already done this. Right. They have existing routes that have been like meticulously pruned to their optimal shape and form, or maybe not, and you can improve them. And then you glue them together into other companies that you've bought, and you improve them yet further still, and then you grow them organically really fast and do a bunch of hyperlocal sub-zip code level targeting to fill out routes further, and you drive enormous labor margin performance in these businesses, and that's a big part of what we do.
And give me a sense of price or value. If you have a business that's doing $4 million of revenue or $500,000 of EBITDA, what's kind of the multiple range that you're seeing?
So it's not unusual for these things to trade at 3 to 4 times. You mostly see them in that range. Sometimes as low as 2, 2.5, as high as 5, 6 if they're big. I imagine the really, really scale players would trade for a lot more, but they haven't traded. So we'll see. But
what are the biggest ones out there? Do you know?
The single biggest pool cleaning company in America is a company called Poolworks. It's actually a franchise out of Australia. They have an interesting
franchise business.
Franchise model.
So they have like many different franchisees kind of owners? Okay.
Yeah, exactly. And they have an interesting model. They actually spin up a retail pool store in any location where you run the franchise, kind of like a Leslie's competitor where you're selling floaties and like chems right out of the store to retail consumers. And then they run a service business on the back end. And there are some advantages to that. You kind of got to base out of somewhere, so you might as well make it a retail store that generates revenue. You also get some more economies of scale on the chems if you're buying in bulk to sell to both retail and for yourself. Interesting model, I think, run well, but it's very early days. Like they're doing maybe 120 million in top line, which is like a rounding error. But your average PE buyer is one operating on 3 to 6 year time horizons, right? So that means that they have to make decisions whose payoff period is shorter than that. So they can't meaningfully invest in, say, technology, because it might take 2 years to go build the tech, and then you're like capturing the value for decades to come. If you're flipping the thing in 3 years, you would never go build that software. So it's the same problem with like public markets and skating to the next quarter and like kind of your next earnings call. You have to be somewhat short-termed in your vision, and you make very different investments than if you have an extremely patient, long-term, near infinite time horizon. And that's us. Like we're going to take as long as it takes to get to IPO scale. And we think we could do it in like 10 some odd years, but like if it takes 15, like I'll be here, right? And so that's the first thing. The second thing is most private equity buyers are not marketing natives. They're at best throwing marketing over the fence to some agency and hoping for the best. And I'm sure you've hired a lot of agencies over the years, but most agencies are running a COGS model on you, and they're not going to be very competitive in a they're not going to help much in a hyper-competitive SEO landscape. The guys who can help you rank for like car insurance are people who could go make $3 million a year selling lamps on the internet, right? Like they can make anything rank. Yeah. And so, they're hard to hire. You kind of need that in-house skill. And I've spent like 20 years building those things. Yeah,
you're the guy.
So
people are like, how do I rank in home services?
Yes,
Jeremy.
We beat out the likes of a whole lot of very
sophisticated So you do your marketing in-house, I assume.
Yes, very much.
Okay.
And then the last thing is technology, right? Like these guys are largely using off-the-shelf solutions. We will use them too, where it makes sense, but we can and have built very kind of robust, bespoke software to solve our unique needs and give us more leverage.
Yeah.
And we are digital natives. Like we, again, are technologists masquerading as finance guys, masquerading as pool guys.
So you can buy a 500,000 EBITDA pool service business for, let's call it $1.5 million. Total value, some maybe on a seller note, some maybe some equity, etc. What do you think a business that's like 10 million of EBITDA in pool service could trade at?
So this is just like conjecture, right? Because we haven't seen them trade.
Yeah.
You know, if you look at the landscape of large-scaled home services platforms that have sold in the last 20 months, there are dozens that have sold for north of 20 times EBITDA.
Mm-hmm.
You know, everything from like Terminix was like a 23x, right? Like Sieva was a 22x. You go down the list from like Arbor to Pest to lawn to HVAC to plumbing to electrical to garage door. These things are trading at 20 times EBITDA at some scale. Rollins, one of the original roll-ups in like pest control, they own Orkin, a bunch of other brands, public company. I think today is like $22 billion market cap.
Wow.
Off of 700 million in like EBITDA. So that is a almost 30x multiple,
Yeah.
right? Like that's an enormous multiple. That's software style multiples. And Rollins is not a software company, right? They are a enormously well-run pest control company.
Mm-hmm.
And so I think like the market has shifted in how they value services businesses. Like home services are one of the last categories that are going to get eaten by AI, right? Like I think about this a lot. By the time you have automated the, you know, somewhat entry level, you know, mid to low wage job of a kind of ground floor pool cleaner, you at that point have automated almost every mechanical job in America,
Yeah.
right?
Yes.
Like all the other industries have fallen,
Yeah.
and like our entire economic model is done.
Right.
So.
It's Wall-E, the real game.
Right, like we'll all be like, yeah, sipping, you know, sludge through straws
Right.
in our VR headsets
Yeah.
at that point. But, you know, I think,
It's not too bad.
yeah. Suffering a shared crisis of meaning
Right.
collectively as a species. But yes, I do think, like, it is, I think, somewhat resilient to AI and automation. Is that going to happen inevitably, eventually? It will probably be one of the last bastions to
Yeah.
kind of hang
Yeah, you're totally isolated. I totally believe that.
Yeah.
Most, if not all, blue-collar industries, for sure.
Mechanically complex, hyperdynamic,
Yeah.
replacing people who make $45 an hour, $20 to $45 an hour, not $400 an hour.
Right. This is great. What else do you want to talk about?
No, this is good. Thanks for having me. It's been a lot of fun.
My pleasure, man. If people wanna kind of check in with your journey and follow along, is there a way to do so?
Yeah, I'm on Twitter at Jeremy Yamaguchi.
Yeah.
You can also email me, jeremy@cabanapools.com.
Yeah.
Otherwise, if you're in the Southern California market and you have a pool, get a quote.
Yeah.
And if you have a pool company,
Yeah.
send me an email.
Okay. What is your plan for the next year or two? How many companies or how much revenue do you have a goal as to what you'd like to get to?
Yeah, we definitely want to do another 4 deals at least. And that would be well over maybe like 3 to 4xing year over year.
Okay.
So we are quite ambitious.
Yeah.
I think you don't get to national IPO scale by moving slow.
Yeah.
When you think about like how many companies you need to own and what sort of revenue you need to be at to be, you know, a national player, it's a big number. And then you think about the time horizon to get there, the only path is a fast one.
Full steam ahead.
You gotta go fast.